Hey everyone, in the previous video we discussed the top 25 wealth creators based on 25 years of research from Mr. Ramdev Agrawal and his team at Motilal Oswal. Based on the study, they established a framework to identify the multibagger stocks for next 25 years. This framework is called QGLP, where Q stands for quality of business and quality of management, G stands for growth in earning, L stands for longevity of both quality and growth, and P stands for reasonable price. Now in this video, I want to cover 25 questions that can help you identify the next multibagger stock. Alright, let's get started. So the 25 questions are organized under 5 broad heads. First is business checklist, second is growth checklist, third is management checklist, fourth is price checklist, and fifth is risk checklist. Let's look at each checklist. Now within business checklist, first question is, what is the history of company and management? Here you need to ask, what is company's business? What is its business infrastructure in terms of number of plants, branches, retail outlet, etc.? Then what is the age of the company? Basically, you should look at older companies much more favorably than younger ones. This is because the old companies have been through all kind of adversities and survived. Hence, old companies' chance of surviving and thriving in the future are much higher. Then is the company owner managed or professionally managed? Then how is the basic financial and stock market performance of the company? To get all these details, you need to study the annual report of the company. Then second question is the company's business model understandable? How does it make money? The key question here is, can you describe company's business in your own words? Is it a product company or service company? Is it a domestic company or a global company? Does it have a monoline or a diversified business? If diversified, what is the business mix? Is the business secular or cyclical? Then who are the major customer? When it comes to customer, there are 3 types of business. First is B2C, that is business to consumer. Second, B2B, that is business to business. And third is B2G, that is business to government. B2C example is FMCG sector, retail sector. Then B2B example is chemical companies. Then B2G example is mainly defense company. B2C companies tend to have higher bargain power with their customer, which is progressively lower for B2B and B2G. Then third question is the company profitable? If not, is it expected to emerge? Basically, the goal of every company is to make profits. It means it should generate high return than its cost of capital. So the key parameter here is consistently generate good ROE. They have put a threshold of 13% for company to be profitable. So higher the ROE, higher the profitability. If a company has high ROE, then it means company possesses strong competitive advantage with good pricing power and require low capital for growth. Some of the examples with high ROE include HUL and Nestle. Then fourth question is, are the company's terms of trade favorable? Is cash flow healthy? Here the idea is to understand whether the company has reasonable bargaining power with its customer and supplier or not. Higher the bargaining power, better it is. For example, DMart has a strong bargaining power over its supplier as it orders products in bulk. So DMart can negotiate the price. However, on customer side, the bargaining power is not that strong as it cannot increase the prices too much, otherwise customer can buy the product from other store. Second, healthy cash flow ensures company's money is not stuck in working capital or fixed capital. So company should have good operating cash flow and positive free cash flow. Again, intermittent negative free cash flow can happen due to capex. However, consistent negative free cash flow is a cause for concern. Then fifth question is, what is management's cost and margin structure? How has it changed in the past? Ideally, you want to invest in company with a consistently high margin structure and avoid cyclical companies with volatile margins. For example, TCS margins are more or less consistent in last many years. Ideally, you want to identify companies where margin expansion is happening. For example, Tata Communication margins have increased from 14-15% to 25% in last 3 years. Then sixth question is, how is the DuPont analysis of the company? DuPont analysis is very important criteria that breaks return on equity into 3 components: profit margin, asset turnover, and leverage. For the company to generate good return on equity, it should have healthy profit margin, good asset turnover, and controlled leverage. Then seventh question is, what is the competitive landscape? What is the role of regulation in the business? Competitive landscape analysis is one of the most important questions as the level of competition and regulation in a sector can make or break the fortunes of players in that sector. Hence, it is important to understand the type of competition in the sector, whether it is a monopoly, oligopoly, or perfect competition. Example of monopoly is IRCTC in railway ticketing and catering, then oligopoly example is CDSL and NSDL and demat account, then it is important to know the key competitors. Then you need to understand, can the company's product be replaced or substituted with other products? Then what is the bargaining power of customers and supplier? Another important point is to understand the regulation on the sector, whether the sector is heavily regulated or not. For example, telecom is a highly regulated sector. Moreover, there is an intense competition in telecom sector. As a result, telecom sector profits have been very low so far. In contrast, paint sector also has competition, but the competition is not cutthroat. Hence, the entire paint sector has continued to create wealth. Ideally, you want to invest in companies where competitive landscape is favorable. The 8th question is, does the company enjoy an economic moat? What are its sources? Economic moat basically means competitive advantage. As long-term investor, the idea is to identify companies that can continue to create wealth in the future. Hence, it is very important to identify factors that makes the company product and service unique or create an entry barrier for competition. Now, what parameters create economic moat? So, one of the parameters is strong brand name that creates customer loyalty. There is no better example of brand loyalty than Apple products. It has a die-hard fan following. Likewise, in Indian context, you have Royal Enfield with die-hard following. Then Asian Paint in paint sector, Fevicol in adhesive sector, Maggi in noodle sector enjoys a strong loyal customer base. Apart from brand, some of the other factors that create economic moat include your patents, cost advantage due to scale, then high switching cost create strong moat, then distribution network create moat. For instance, today you can find HUL and IDC product in every nook and corner of the country. It took these companies decades to spread their distribution network, which is not easy to replicate. In spite of strong economic moat, sometimes there are disruptions in the sector that breaches the moat. One of the example is auto sector. At one point, Hero Moto was undisputed leader in two-wheeler segment in India and Maruti Suzuki was undisputed leader in four-wheeler sector. But today, auto segment is disrupted by electric vehicle. Although Maruti and Hero are still the leaders, but nobody knows if they can continue the leadership in the new disruptive world. Also, sometimes a new competitor with deep pocket enter into the market and eat the market share. For example, a few years ago, there were only two major players in organized grocery retail sector in India, D-Mart and Big Bazaar. However, in last few years, Reliance has entered into the sector with deep pockets and even acquired Big Bazaar after it got failed. Then even Tata Group has now aggressively forayed into organized grocery retail with its chain of store under the brand Star Market. So ideally, you want the economic moat to be as sustainable as possible. Within growth checklist, 9th question is, what is the addressable market opportunity and its key drivers? No matter how good a company is, if the market itself is not growing, then company can't create wealth. Hence, it is very important to understand the addressable market opportunity and key growth drivers. For example, if you look at India's car population, it is estimated at around 30 million and there are 250 million families in India. So currently the car penetration in India is just around 10-12%. Compared to that, developed countries like US, UK have around 80 to 100% car penetration and even China has around 45% car penetration. So you can imagine the huge addressable market for cars in India. Likewise, there are many sectors with immense growth opportunity. For example, mutual fund industry in India is still in nascent stages. The total AUM of Indian mutual fund industry is just around $0.5 trillion, whereas this number in US is $25 trillion. As more and more people would join white-collar jobs in India, they would want to invest the money in Indian economy, and hence, mutual fund industry is bound to grow. Likewise, one of the trend is China plus one, where global MNCs are looking for alternative to China in manufacturing, and India has emerged as great alternative. So it is very important to identify the addressable market opportunity and key drivers. Then 10th question is, what is company's growth plan and how sustainable is the growth? Once you identify the market opportunity, you need to understand company's growth plan in terms of capacity expansion, hiring employees, launch of new product services, mergers and acquisition, etc. One of the example is Reliance Industry. It identified huge opportunity in organized retail segment and has expanded its store network in the entire country. It also acquired multiple companies and of course it expanded its capacity and hired a lot of employees. Likewise, ITC has used its distribution network to expand its product portfolio from cigarette to FMCG. In this growth, it mainly focused on building a portfolio of healthy food and packaged food category that are in high demand due to lack of time for cooking that gives ITC a sustainable advantage. Now within management checklist, 11th question is the management high on integrity and transparency? Ultimately, the leader of the company is like a captain of the ship. Just like the captain of the ship decide the fate whether the ship will sail through or will it sink, a company's leadership will decide whether the company will become a wealth creator or wealth destroyer. So basically, we need to understand how the top leadership deals with all the stakeholders of the company, including its employees, investors, shareholders, and customers. Ideally, you want to invest in a company with solid corporate governance with a clean track record of the leader. A good leader will always ensure employee-friendly policy and offer best products for its customer without compromising with quality. A good leader would periodically share the true picture of the company's performance with its shareholder in terms of annual report, quarterly con calls, etc. and maintain a rational policy for dividends and buyback. A good leader will also ensure social responsibility towards community and environment. For example, there were two private banks that started their journey at similar time in early 2000. While one of them generated nearly 300 times return, another went bankrupt. I am talking about Kotak Mahindra and Yes Bank. Kotak Mahindra under the leadership of Uday Kotak generated 300 times return in its journey so far, whereas Yes Bank under the leadership of Mr. Rana Kapoor got collapsed. Why? Because Mr. Uday Kotak instilled the right business practice and corporate governance by ensuring that his bank gives loan only to deserving candidate. Whereas Rana Kapoor, out of greed to grow quickly, ended up giving loans to his friends whom even other banks denied giving loan. So corporate governance is a major building block of a multi-bagger company. Hence, always do a background check on company's leadership. Of course, it is not easy to identify management integrity on public domain, but try to listen to their interviews that gives a good sense of their thought process and ethics. You can even inquire from the existing employees of the company about the leadership. Then 12th question is the management competent? It is not just integrity, but management competence is also equally important. To check the management competency, you can look at the operating margin of the company, whether the margins are stale, increasing or declining. Then you can look at company's earning growth vis-a-vis its competitor. So basically, company's financial parameter speaks about management competence. For example, Tata Communication was struggling with margins until 2019, where it had around margins of 14-15%. But after the new MD A. Lakshmi Narayanan joined the company, Tata Communication margins are in the range of 25%. Likewise, TCS was number 2 in early 2000 in IT sector after Infosys. But under the leadership of then CEO Mr. N. Chandra, TCS became number 1. Under the leadership of Mr. Murli K. Divis Lab has become number 1 in generic API manufacturing in India. Then 13th question is, does the management have passion and growth mindset? In addition to integrity and competence, management should have a growth mindset that takes challenges and doesn't fear from failures. One of the great examples is Motherson Sumi inorganic growth strategy under the leadership of Mr. Vivek Sehgal. Then 14th question is, does the company have a rational capital allocation policy? When company generates cash, the question is, what does it do with the cash? Does it redeploy the money in the business growth? Does it simply hold the cash? Does it pay dividends? Does it buy back shares? A right capital allocation is very important to ensure that company is always ahead of competition and utilize the cash judiciously for future growth. 15th question is, does the company have a suitable organization structure and management depth? Apart from CEO and MD, you need to look at organization structure and key leaders in each department. Then 16th question is, what is the organization culture? It basically means, what are the values and beliefs of the company? A right culture in the organization attracts and retains the best talent. If the company has a toxic culture with high pressure on employees, it can't sustain its growth. To know about the culture, you can reach out to a few employees of the company. Next, does the company have a sound succession plan? So a company can be either owner managed or professionally managed. If it is owner managed, does it have next generation member ready to lead in the future with required knowledge and expertise? If it is professionally managed, whether the succession from within the company or outside. For instance, with Infosys, we have seen when Narayan Murthy retired, at one point when Infosys was run by Mr. Vishal Sikka, it got into a lot of trouble. And then Mr. Nandan Nilekani had to step in as chairman. So right successor planning is the key. Next question, do the owner have enough skin in the game? It means whether the owner have significant shareholding in the company or not, and whether the owners are involved in day-to-day operation of the business or not. Next question, have the promoters pledged a large portion of their holding and why? Pledging means promoter taking loan against company shares as collateral. Ideally, promoters should avoid pledging their shares. Once you cover the business growth and management, next step is to ensure that you invest at right price. So 20th question is, has the financial model been done with estimates for at least 3 years? You need to look at the financial data of the company at least for last 3 years. That include analysis of company's revenue growth, profit growth, operating margin, gross margin, net margin, operating cash flow, free cash flow analysis, then important ratios like return on equity, return on capital employed, debt to equity, working capital cycle. Based on the analysis, you need to estimate company's future earning, profitability, cash flow, etc. and accordingly put a value against the company. Although it is not an easy exercise, but the idea of financial modeling is to quantify the future potential in terms of numbers. Next question, is it a QGL stock? Based on the analysis done so far, you need to establish if the company qualifies on QGL, that is quality, growth and longevity parameter. Next, is valuation reasonable? One of the key formula to gauge valuation is PE, that is price to earning ratio. Since ultimately the stock price is a function of earning, PE ratio suggests how much money are you willing to pay for 1 rupee of earning. For example, if the stock has an earning per share of 80 rupee and its stock price is 2000 rupee, then its PE ratio is 25. Now, how do you know if a PE of 25 is good or bad? So there's no foolproof way to get the right idea of valuation. Some of the ways are identifying the median PE of the company in last 3 to 5 years, and if the current PE is lower than the median, then valuations are attractive. Then you can compare the PE ratio of similar companies in the same sector. For example, you can compare PE ratio of ICICI Bank and HDFC Bank. Then you can compare PE ratio of Infosys with TCS and likewise. Another parameter to gauge valuation is price to sale and price to book value. And final parameter is PEG ratio. PEG ratio is calculated as trailing 12 months PE divided by earning CAGR for next 3 to 5 years. Here remember that it is not past earning, it's next 3 to 5 years earning estimate. Lower the PEG ratio, better it is. Historically, PEG ratio of lower than 1.5 suggests attractive valuation. Next question, is there enough margin of safety? Margin of safety is the difference between the intrinsic value of the stock and its market price. That is price value gap. The greater the difference, the better it is for the investor. For example, if the stock is trading at let's say 500 rupee, then you need to identify the intrinsic value of that stock. Is it more than 500 rupee or less than 500? One of the way to calculate intrinsic value is via discounted cash flow method. Then next question is the stock reasonably liquid? Stocks which are illiquid carry significant impact cost, that is buying even small quantity will cause the price to increase. Also, when the investor decides to sell the stock, prices get hammered due to low liquidity. So ensure that the stock has good free float market cap and has a decent trading volume. And final question under risk checklist is what can go wrong with company narrative and numbers? Here you need to identify the key risk with the company or sector. For example, we have seen how rising crude oil prices can impact the raw material cost of companies and eventually impact their profitability. Likewise, some sectors are cyclical in nature, so that is again a risk. Then some sectors are prone to regulation. In IT sector, one of the key risks is attrition, that is employees switching jobs. Then competition is a major risk in almost every sector. So risk assessment is an important exercise before investing your money. So in this video, we discussed 25 questions that you should ask before shortlisting a stock for long-term investment. I hope this video will give you a good direction in terms of how to identify the next multibagger stock. If you want to learn in-depth about stock fundamental analysis, I have a complete course. And if you want me to cover any specific topic on YouTube, let me know in the comment. And if you haven't subscribed to the channel, then do consider subscribing it. I'll see you in the next video. Till then, take care.